Now, a very good afternoon, good morning. Welcome to FX Week Ahead Live Market Analysis with myself, Giles Coghlan, for HYCM's webinar. Do hope everybody is doing well. Alexandro, good to have you there. Larissa, Gabriel, Mustafa, good to see some regular names, just as different folks are signing in. Don't forget, as we look at different entries and different exits and different instruments, all of this is from a broader perspective of an educational webinar. It's not meant to be a signal trading service or anything like that. It's simply saying how I'm going about looking at the markets, someone with a professional trading background, and it's not a signal trading service, for instance. Okay, so looking ahead, we just have a number of big events coming this week, and some of the most important ones are from the US data. So I just want to run through that US data with you so you can see that. Also look at the RBA interest rate decision coming on Tuesday. Now, that's going to be a very crucial decision on Tuesday. And the Chinese data that we've had as well is quite interesting for the China 50 from a medium-term perspective, and gold is at a really crucial place here. So there's a lot of very interesting dynamics going on that we're going to be looking at for this week. I'm just going to check some messages. Okay, so without further ado, let's get stuck into the session. Don't forget, as we're looking at different entries, exits, feel free to ask answers and questions any moment that you want. Very happy to answer those questions. Okay, so here we go. Now, the big picture we've got to be aware of this week is twofold. So first of all, I want you to take a look at stocks. And if you look at the S&P 500, the Dow, the NASDAQ, you'll see that these stocks have been on a really strong rally high recently. And there's a lot of analysts saying that this is very stretched positioning, and they're very concerned about this continuing on. So watch for any bad news to potentially sink US stocks. The general US economy is slowing down, so it's not expected that this stock rally can keep continuing. So if it does continue up to the recent highs, then watch for selling at those all-time highs. Otherwise, watch for some sort of a catalyst to send stocks lower potentially in the coming weeks. And I'll look at some key US data to be looking at. China's 50, this is very interesting. If you look at China's 50 from a longer term point of view, this does potentially look like pretty good value. You can see that the peak to trough that we've had from 2021 through to this year is like nearly 45, nearly 50%, so 45% peak to trough. So potentially this area does look good potentially from a longer term point of view. So do be aware that longer term upside in China's 50 does look pretty attractive, and stops could be placed very tightly just below this 11,000 region. So if price goes back below that 11,000 region, okay, you can know that technically that support has not held. So that's very encouraging. And a lot of the bad news seems priced in now for China. We've had a string of negative data points, and China's recovery has been very slow. And despite sort of the negative news we've had, we're seeing sort of some bottoming action taking place. Just simply sometimes that there can be so much bad news that it's all priced in, and then markets can suddenly start finding a bottom. So look out for that over the medium term for China's 50. Commodities, they've seen a bit of upside, particularly gold and silver, trying to bottom. Now, if you just take a look at gold, let me show you this different charts. I'll show you here on the oil chart. Let's just now you see how gold is trying to bottom off that 200 exponential moving average. Big support, 1900 level, price is trying to bottom. So look out, this could be the bottom for gold. And if anyone, some investors will be trying their hand at this being the bottom, with stops just running out underneath that 1880. Now, the big picture for gold's expected to potentially move higher as yields drop and the dollar drops. So the chart to be looking for, and do check out my blog because I talk about this in significant detail. If you look at, let me just get rid of that. If you look at this chart here, what you'll see is that when you have the dollar and real yields moving together, and real yields here in the light blue, you see gold moving the opposite direction. So dollar and real yields moving higher, gold moves lower. When you see the dollar and real yield moving lower, you see gold moves higher. Okay, dollar and real yields moving, gold means higher. So what we want to see is if we start to see the dollar and real yields dropping lower again, then that will be a good upside potentially for gold. And we do appear to be quite close to peak terminal rates with US bonds. And you can see that bonds are trying to sort of break out this level, but they are in line with this major sort of potential trend line area. Yields moved up into that, sold off, and bonds are offering quite good value here for longer term investors. So you'd be quite surprised to see yields keep moving higher. We'll look at the data that will cause it to move higher if it is, but all that should mean that potentially gold could find some significant buys. I'll show you what to look for this week in terms of US data, but definitely very, very significant to be looking at that. WTI finding a bit of upside on the news. Saudi is going to extend their production cuts for another month. That's just supporting oil today. And we're seeing bond yields fairly high levels, and that looks quite attractive for bond buyers. So watch out for bond buyers stepping in here. Could expect these yields to move lower over the next sort of 3 to 6 weeks. That's certainly what I'm expecting as interest rates sort of peak. Got to be quite close to that. Look at the dollar yen. This is at that 145 region. This is an area where the Bank of Japan have acted on before. They don't like the yen getting so weak against the dollar. So watch out for potential sellers at this 145 level. Look out for Bank of Japan action, and they get concerned about a weak yen, and that weak yen eventually will have the Bank of Japan acting. So watch out for that. And of course, you can see here US 10-year yields. You see how the dollar yen tracks the path of US 10-year yields. You see when US 10-year yields up, dollar yen up, US 10-year yields down, dollar yen down. So if we start to see a peak for yields, then we'd likely see a peak for dollar yen. So this could potentially be a peak for the dollar yen. Just watch out for it. One way to potentially play it will be looking at this trend line. And if price breaks down below that trend line, go with sellers, okay? And as long as it stays below, stay with it. Or you could do a very tight trend line here and just say, okay, if price breaks below that trend line here, you got 1, 2, 3 touches, that will do. If price breaks below that trend line, then sellers will go with the break, and expect sellers as long as they remain below that trend line. So that's definitely worth watching on the dollar yen, particularly if we see yields moving any higher. That's likely to get the Bank of Japan pretty nervous. Okay, now I want to show you some things for this week that's very, very important. Just checking no one's asking any questions. Yeah, okay, we're all right. Okay, so first off is the Reserve Bank of Australia meeting that's happening overnight. US holiday going on at the moment. It's holiday celebrations in the US and tomorrow as well, long weekend for the US. But coming up overnight is the RBA interest rate decision. It's 5:30 a.m. UK time. Now, the last decision, the Reserve Bank of Australia hiked interest rates in a surprise move. And the reason they hiked interest rate in a surprise move was that inflation was stickier. You can see here the headline inflation in Australia 7%, and the core inflation is 6.6%. So very high inflation readings for Australia, and their jobs data, look, they're continually adding jobs to the economy. So strong jobs, remember, that's inflationary, because if there's lots of people in work, they are able to demand higher wages from their employers. That is because the power is in their court, and that means those wages are getting paid into the economy, and it's inflationary. Whereas low employment is deflationary. So look at this, inflationary pressure in Australia. That's why the Reserve Bank of Australia surprised markets with interest rate hikes last meeting. Now, they're expected to be on hold for the 4th of July, early AM time UK. They're expected to hike by interest rate by 25 basis, only 37%. So if they do hike by 25 basis points, the key thing we need to look for is where's the terminal rate? That's the most important thing. Where do the RBA see them ending up in terms of how high interest rates will have to go? Now, at the moment, they're expecting to move interest rates up to about 4.62%, which is very, very high. And that is 2 more interest rate hikes are expected between now and the spring of next year. So that's what short-term interest rate markets are saying. So if the RBA hike by 25 basis points, you'd expect the Australian dollar to surge higher, say against the New Zealand dollar. But if they then say that's the last interest rate hike we've done, then all this stir market pricing will have to be unwound. So you'd expect the Australian dollar to fall. So what's important is not so much necessarily the decision, it's the decision and what they indicate about how high interest rates will have to go. At the moment, there are good reasons for the RBA to have to hike interest rates again, okay? And you can have a little look here, and I've got a seasonal outlook with the Aussie New Zealand dollar. So if they do sort of signal a very, they signal peak interest rates, then you would typically expect Aussie New Zealand dollar to fall lower. So that's definitely something to be looking for. And I'm just going to put this in the chat area so you can see this seasonal pattern that exists. Now, I wouldn't be trading this just blindly. It would only be if the RBA sort of say, we've reached terminal rate with a hike, or even if the best opportunity would be if they don't hike interest rates and they say that's it, we're not expecting any more interest rate hikes. It's unlikely because, as I said, look, jobs are rising, core inflation is still high, headline inflation is still high. Like, that's triple what the RBA's target is for both the headline and the core. So there clearly is an inflationary problem in Australia, but you can see the terminal rate of 5.59%. So in other words, 2 more 25 basis point rate hike is what the markets are expecting. On the Wednesday, we have US data that's important. So we've got some US factory orders and FOMC minutes coming during the session. So what I want to see for factory orders is that increasing? If factory orders are decreasing, then that should be negative for the dollar, negative for yields, positive for gold. If we see weakening in the US economy, if in the minutes we see any sense in which the Federal Reserve members won't hike interest rates, remember Powell's been saying continually since the last Federal Reserve meeting that the central bank will be hiking interest rates twice. So if you look at the last Federal Reserve decision, what they basically said is via the dot plot that there's 2 more interest rate hikes still to come. Okay, that's what they're saying, and that's what Powell's been saying consistently since the last meeting. So yes, the last interest rate meeting in the US was a skip, But you look at the terminal rate and you can see that markets are expecting one more interest rate hike and a little bit still to come. So it's a pause rather than it's a skip a meeting rather than a total pause, if you know what I mean. So what that means is when we get the FOMC minutes out, if there's anything in there that indicates the Fed may be at terminal rate or could be at terminal rate, then you'd expect dollars to sell off, yields to sell off, gold to rise, stocks to rise, although I'm not expecting that at all. Now on Thursday, we've got some important US data, these ISM services, jobless claims and JOLTS. This is going to be very important for US. Now what we want to see ideally, if we see a miss in the jobless claims, so there's extra jobless claims above 270,000, if we see ISM services PMI coming in below market's minimum expectations, if we see that coming in below 54, if we see new orders surprising to the downside, if we see job openings falling surprisingly lower, job quits rising, if we see that kind of scenario where there's a clear slowdown in the US economy, then short-term interest rate markets are going to be a lot less confident that the Federal Reserve will be needing to be aggressive in terms of hiking interest rates. So if we get bad US data on the Thursday, that should lift gold because you expect yields to fall lower, you expect the dollar to fall lower, stocks to rise, and gold to gain. So that's the thing to look for, because you remember on Friday, we had the core PCE print, and that core PCE print was pretty decent. It showed that PCE is starting to fall in the right direction. Now, it's not brilliant, so it wasn't below market's minimum expectations, but it was showing a reduction in inflationary pressure. And that's why gold was able to try to find a bottom there and pushed up from that level. So just to be aware of that dynamic is very much likely to repeat itself on Thursday if we see a big miss in the US data. Now, on the Friday, we've got the non-farm payroll. I will do a workshop on Wednesday showing exactly what to look for that. We'll do a deep rundown, but the basics is that we want to see a miss in the US data. We want to see a slackening in the US labor market. We want to see more people out of work. We want to see higher unemployment level. Not that we want people to be out of work at all, but in terms of how aggressive the Federal Reserve will be. If those readings surprise to the downside, that will mean gold should get another lift higher, the dollar should fall lower, stocks should move higher, and you'd expect euro US dollar to move higher. Canadian employment data is going to be important. If you look at the Commitment of Traders report, what you can see in terms of commercial open interest is that quite a lot of traders are quite short the CAD at the moment. There is kind of expectations that the Bank of Canada may be quite near terminal rate. So if the Canadian labour data comes in very strong, it will increase expectations that the Bank of Canada may need to hike interest rates at their 12th of July meeting. It's a bit of a coin toss at the moment. So if we see a big, strong data print for the Canadian jobs, that should lift the Canadian dollar and particularly lift it against a weaker currency. So the big point to look for this week is US data. The market will be really looking at this, trying to assess what that means for the path of interest rates for the Fed. And if we start to see interest rate cuts being expected, if we start to see maybe no interest rate hike expected at all, if we saw that, then that would be a natural upwind and boost for gold, stocks, and weakening the US dollar. So that's definitely something to be looking for as we head into the Friday Canadian jobs data. Only other point that was worth noticing is that today we did have an interesting print, which is the Swiss inflation print coming in quite low. 1.7%, that is below the 2% target. Now, if we look at inflation in Switzerland, we see that, yeah, that's good. June's 1.7%. That is below the 2% target and below the 1.8% forecast. So that could mean the Swiss National Bank may not be need to be so aggressive. At the moment, they're at 1.75%, and markets see a 61% chance that they're going to be hiking up to 2%. But that just takes a bit of pressure off the Swiss National Bank. Okay, so you could see a little bit of weakness today in the US dollar Swiss franc pair. So potentially, if I just change these settings, let's look at the daily traditional. So I just, oops, change this back to color. Okay, and there we go. Okay, that should be better there. What we could expect here is I would anticipate buyers from that pivot point today. So any move back down to that pivot point, or ideally this support here at the 0.8950 region, I expect buyers for today's session, and stops to be placed just underneath that S2 pivot point, and then and then closing out before the end of the session. So any move back down to that 8.950 region, I expect to find buyers and potentially looking taking profit at that 8.970, 8.971 region. So just be aware of that on that weak inflation print that we had today out of Switzerland, which can take a bit of the pressure off the Swiss National Bank. Yeah, Gavro, what's the best way of identifying the strongest and the weakest currency? Well, what you can do is you can go to TradingView, and if you put these sort of codes, see these codes up here? Let me show you. If you see that code here, right? If you copy that code, Gabriel, and put that in for like Euro, Pound, Aussie, right? And then you can get like a currency strength meter like this, and you can easily see which one's the strongest. So today at the moment, New Zealand dollar is the strongest currency, Swiss franc is the weakest, which makes sense after that inflation print. And yeah, the OPEC meeting, yeah, basically the big correlation between oil is seen in the Canadian dollar. Okay, so if we just look at the CAD, right, and if you just look at US oil, you can see that when you have oil gaining, CAD gains. When you have oil falling, CAD falls. When you have oil falling, CAD falls. You have oil rising, CAD gains. So the big correlation you need to be aware of, Alex, with oil is the Canadian dollar. That's because there's so much oil exports in Canada. They've got a lot of exports that goes on. And the OPEC meeting is interesting because some journalists are being forbidden of going into the OPEC meeting, which is interesting, what that actually means. But Saudi have just said that they have announced an extension of their production cuts, which is very interesting. What they've done is they're going to prolong its oil production cut by 1 month. They're keeping a lid on supply, even as the market is expected to tighten, basically. So that's given a little boost to oil at the moment. And that's why we've seen oil just have a little bit of upside in today's session. And you've got the OPEC meeting coming, the 5th and 6th of July, so Wednesday, Thursday. Yeah, that's right. Bloomberg reported that, and that's from the source they've given is Saudi state-run news agency. So Saudi is saying that, which is good news for oil buyers, and also they're trying to put a decent support level in here. So we've just moved up to that overhead resistance level, okay, which is, a key sort of area for WTI. Okay, folks, so that's really where we're at today this week. We'll be back here on Friday to get us totally ready for the NFP. For me, the best opportunity I'm looking for is gold on that non-farm payroll print. That's what I want to look for. I want to see weak US data to give an upside bias in gold. That's definitely what I'm mainly focusing on this week. Okay, folks. Yeah, you're very welcome, Elitza. Said. Yes, Said. If you could ask the tech team as well, it helps. I think I have asked them recently. They said they have been speeding it up. I'm sorry, but if you keep asking the tech team themselves, yeah, I will ask them to do it sooner. Okay, thank you all very much. Take care and have a good week. I will be back here on Wednesday for the workshop, getting us totally ready for that non-farm payroll event, and I'll go through that in significant detail. Thanks everyone now. Take care. Goodbye.